If I elect to aggregate rental properties into one activity, for example, managing operating single-family homes as rentals and a limited partnership interest in a multifamily syndication, and electing all of my investment real estate as one activity, which you can do, it's called an aggregation election. What happens if years down the road, one of the assets is sold from the aggregate group? What are the tax and legal implications, Jeff?
Okay, I'm going to make the answer probably shorter than the question. If I sell a property that I've aggregated with other properties, treat it like any other sale of property.
Yep.
The one thing it doesn't allow you to do is if that property had passive losses embedded in it, it does not release those passive losses until you've sold substantially all of your portfolio that you aggregated.
In other words, if you have a whole bunch of loss that you're looking at going, man, the only way I'm going to get to use that loss is if I sell the property, don't aggregate that with your other properties, right?
Well, the problem with the aggregation rule, it pulls in all,
there's no way,
all real estate, yeah.
So you're toast.
Yeah.
So then you wouldn't aggregate under those circumstances if you were like, man, I need that because I'm going to be selling it soon. But you don't lose the loss carry forward, right? You just use it against passive income. So if you have a bunch of other properties that are making money and you're like, shoot, there's no reason not to aggregate because you could use those passive losses against the income that's being generated.
Yeah, that's a really good point, Toby, is that if I have aggregated property that has passive losses in it, I want to find passive income elsewhere that's not necessarily real estate to offset my passive losses with.
Yeah. And by the way, it doesn't have to be just real estate, right? It could be your silent partner in a pizza shop. Ooh. And I always use Toby's Pizzas because one day I'm going to have a pizza shop. You guys just wait. It's gonna be Toby's Pizza. It's going to be good. I've been practicing my uni.
So much cheese on it.
I know. I've learned my lesson with my uni. Don't put too much cheese on those things, right? I'm the worst pizza maker ever. But let's just say that I open it up. It would kick out losses like nobody's business. But if you invest in something and you're the silent owner and you have profit coming in, then yeah, I have losses sitting over here, passive losses. I could make sure that that income is not taxable. So it's going to offset that. So you see a lot of folks that are tax savvy and good investors. They may have several investments. People are always like, why would you invest in a restaurant? Why would you invest in that? And a lot of times they're saying, because I'm a silent owner and it's going to kick me income. These things are profitable. It's not huge, but I have losses. So it's just tax-free money for me. If it kicks me $20,000 a year, I didn't have to pay the 50% tax if I'm in California, or 40% tax if I'm someplace else, right? I'm saving a bunch of money, not having to pay it. So it'd be cool. Somebody says, if I come to Vegas, will all the road construction be done? Holy smokes, it was terrible 2 weeks ago. Yes, it should be done because the F1, no, stop it, Patty. The F1 is next week. It'll be done.
And I think Tropicana won't be complete yet.
How they're doing that whole, yeah, but I don't think that's messing up the strip. That's the
F1, yeah.
The F1's what's screwing us up. The state flower is a traffic cone. That's about right. Been to Vegas before. It's almost like they don't want you out of the casino. If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.